We last spoke to you early last month, and it was a really different macroeconomic environment.
Sure.
The inflation outlook was different. There was no war in Iran going on. Oil prices were around $60 a barrel. How has all of that affected your world?
Yeah. Well, look, I think we're in a transition market right now where fundamentals aren't really changing as far as the fundamentals of housing, but we are seeing transaction volume increase. So I think this is because we are finally seeing some stability in interest rates, even though they didn't go exactly where everybody thought they would go or where everyone wanted them to go. What happened is now people know what to underwrite to as far as buyers, and sellers aren't sitting there waiting for these massive rate cuts and waiting for cap rates to drop. And so we're getting a little bit more alignment on pricing.
So like people aren't just waiting around. Well, maybe it could get better. We have an understanding of kind of where we're going to be.
Exactly. Like this is what you get right now. And sure, we're getting a little bit of volatility right now with the war on rates, but generally speaking, Fed's not cutting rates right now. Nobody's expecting them to. And so now we also have at the same time a slowing down of construction starts, which is going to create future supply constraints. And so that sets us up for a very solid investment period for particularly what we do, workforce housing, where you still have those fundamentals that are strong, people still need a place to live, and now we provide that without having this extra supply coming in, and so it creates that extra value.
What do you think about on the demand side, though, in terms of people who need this housing? Like, this is one of the things we talk about in terms of AI and work, and if the economy starts to have some issues, people maybe they think differently about their living situations. How does that stuff impact you as well?
Yeah, well,
or could
we do always have a demand. Now that doesn't mean that there's always going to be demand for affordable housing, because these are renters by necessity, not lifestyle renters who are choosing where they're going to live, right? That being said, that doesn't mean that the bottom sector doesn't get hurt by macroeconomics, and so then we have to deal with that. And of course, we've got rising labor costs and material costs, and when you get inflation, it's going to hurt your tenants. At the same time, on the flip side, real estate is a hedge against inflation. So for investors, this is where they want to be.
Does it dwindle supply for you? Because, and I know you're very picky about what markets you're in, and you've decided not to work in some markets that you used to be in, and you've decided to exit or enter different markets based on timing. But if this is an asset class that is attractive right now in an environment such as this, then does that make it more difficult for you to acquire new targets?
So for us, it's all about acquiring at the right basis. And so right now, it's about being a very discerning investor.
But it's a very efficient market, because there are a lot of people who are looking at this stuff.
Sure. So we in particular are buying highly distressed deals. They have a lot of managerial distress, high vacancies, high delinquencies, and then we're catering to a need that we're not competing with new building against. So we are catering to tenants who have an AMI or area median income between 30 and 80%. You can't build new construction without government subsidies and compete against that. And so for us, that means there is great value there, right? But what we have to do is we find things at auction, or we're finding things that are negative cash flowing. And that's where we are basically taking existing supply that is not functional and unlocking it and bringing it back on the market.
So one of the things we were thinking about, Amy, before when we were on our planning call this morning, is that what we love talking about you is, in an environment where, we don't know when this war is going to end, and that opens up so many different questions about the outlook, right? And so we're just dealing with lots of questions. But are you, talking to someone like you, are you seeing more distressed opportunities to buy as an indicator that things are getting tougher out there, or no? Does that pool kind of stay constant?
So for us, it does. The level of distress that we're buying is not macro distress. I think that you do, it's not based off of macroeconomic distress, right?
Okay.
I think you do see, as when you look at properties that are a little bit less distressed, you're seeing more trading right now, because as maturities are coming up on loans and it's harder to refinance into new things, and you see sellers kind of lowering their expectations, right? But for us, it always is going to exist. It's just about finding those deals that are really hurting, and not because of interest rates, but something bigger than that.
When you find a deal that might be negative cash flow or there are managerial issues, what are the reasons why it's not working for that particular management company?
So the properties that we buy need a serious infusion of capital. And so if an owner does not have that capital to put back into that property, now why did it get to that place?
Yeah.
It could be a combination of many different things. So it could be that the operator didn't quite know how to operate this kind of asset, this sort of workforce housing asset. Often the sellers that we are buying from are not traditional real estate operators. Maybe they have a different career path, and then
They got in over their heads?
yes.
Okay. So if you're in a situation such as that, and like I know every situation is different, every building or every asset is different. What percentage of the renters typically stick around during this overhaul? Like,
Sure.
can you keep them in their homes?
Sure,
while you're
we try to
making
keep
these changes?
everybody. We want to keep our tenants. We do not want to displace them. That being said, sometimes we do lose tenants if there is, if we're trying to clean up crime in a property, or if someone flat out refuses to pay rent and cannot find any sort of financial help, which we are pretty good at pairing people up with some sort of financial help. But there are cases where people do have to vacate.
It sounds like a lot of the macro doesn't necessarily impact you guys directly in what you're doing. Is that fair to say?
I would say we're fairly hedged from macro. It doesn't mean we don't get headwinds or tailwinds, but we're fairly hedged in our asset class.
So what is the biggest thing then in terms of risks that you think about most often? And we just got about 40 seconds left.
Sure. I mean, the risks we see is the pace of lease up, or the amount of delinquencies that we see, and the pacing of that. Our returns are a bit outsized, so we do have cushion to absorb some of that, as they have to be when you're investing into distressed real estate.